No one understands market trends better than its top insiders. They can foresee bullish and bearish developments way before everyone else does. Insiders are corporate CEOs, senior executives, board members, or shareholders who own at least 10% of a company. They always come out on top when buying and selling stock. They always reap the biggest profits. They're always one step ahead than everyone else. That's why market watchers use insider activity as an indication of the future price movement of any given stock. Those in positions of power are not only trendsetters, but they effectively know where the market is headed. Have you ever wondered why? How can they know what's gonna happen before it actually happens? How can they tell that the price of a given stock is gonna soar or crash? If your answer was because the market is obviously rigged, then you're probably right. For a long time, some retail investors, new players, and market watchers have been telling us that insiders can make decisions based on non-public information. They have privileged intel that gives them an advantage when it comes to predicting market swings. That means the stock market is not a level playing field. As Mississippi College School of Law professor John Anderson explained, it's really easy to say that our markets should be a level playing field, but the reality is they've never been. People come to the market because they think they have better information, better understanding than their counterparties, he added. Unfortunately, that's far from the truth. Most Americans today believe the stock market is rigged, and they're right, said Daniel Taylor, a professor at the Wharton School and the head of the Wharton Forensic Analytics Lab. Corporate insiders have access to information that sometimes never hits the public, and even when it does, they always start trading before the news is made public, which means they've got time to prepare and reposition their portfolios before a stock market crash occurs. The high rate of success these insiders have may look like it's just luck, or the result of years of experience, and although that might be true in some cases, Wall Street's open secret is that insiders trade on what they know, especially when stakes are this high. There is a lack of appreciation for the amount of opportunistic abuse that exists under the current system. The amount of egregiousness, Taylor continued. On the same note, Ankush Kaduri, a prosecutor in the fraud section of the Justice Department, stressed that insiders have some legitimate advantage over everyone else. They have experience and expertise that allows them to put public information into context in a way that others cannot. That allows a defense lawyer to say, this wasn't inside information, they were just better at reading what was already out there. Over the years, the definition of insider trading has changed multiple times, but what most Americans believe and what many market watchers have been telling us is actually correct. The stock market is a rigged game that benefits corporate executives who can hide behind trading plans as they buy or sell stock, sometimes based on non-public information. That's what zero-hedge analysts have been warning their readers for years, and now they're inviting the public to see what those insiders, those executives, and those CEOs are doing right now and what that means for the future of the stock market. Spoiler alert! A disaster is looming, and corporate executives are already looking for ways of protecting their wealth before things get out of control. Recently, we've been hearing stories of billionaire executives massively dumping their company's stocks. That's actually been happening at a much faster rate than we've seen in over a decade. The twist is, as zero-hedge analysts explained, that they're ramping up selling while their own companies engage in record stock buybacks. Last month, insiders dumped a total of $15.59 billion. That is an absolute all-time record According to the Wall Street Journal, citing data from the research firm Insider Score, 48 top executives have collectively disposed of over $200 million each in stock sales just this year, 2021. That's nearly 4 times the average of stock sales from 2016 through 2020. The avalanche of insider selling includes the 2 richest men in the world, Amazon CEO Jeff Bezos and Tesla CEO Elon Musk, as well as Google co-founders Larry Page and Sergey Brin, cosmetics billionaire Ronald Lauder, Walmart's Walton family, and Facebook and Meta Platforms CEO Mark Zuckerberg, among many others. In recent weeks, they have significantly accelerated stock sales. Insider Score data reveals that corporate insiders sold a whopping $63.5 billion in shares in November. That is a mind-blowing 50% increase compared to all of 2020. This selling trend is developing as major equity stock indexes are signaling peak levels and stock buybacks are occurring at breakneck speed. The largest share of insider dumping is happening in the technology sector, which recorded a staggering $41 billion in sales. What you're seeing is unprecedented, outlined Wharton's Taylor. The professor also reminded that what's occurring now resembles a lot like the selling wave seen almost 20 years ago, right before the dot-com crash. Taylor emphasizes insiders' impeccable timing of selling their stocks at the market top to start buying them back at the bottom, a main indicator that they know a deeper stock market crash is coming. In a recent report, Goldman Sachs exposed that an extraordinary amount of stock buybacks have been purchased this year, ranging from $885 to $925 billion, which suggests that insiders are getting rid of the stocks of their own companies on secondary markets. Stock buybacks are an alternative form of wealth protection. CEOs sell their stocks to raise cash, but instead of using this cash to expand production or increase sales or acquire competitors or buy new products or services, they use it to reduce the outstanding share count of their company and artificially inflate earnings per share. That's what Real Investment Advice Chief Market Strategist Lance Roberts has explained in a 2019 article, saying the reason that companies do this is simple: stock-based compensation. Today, more than ever, many corporate executives have a large percentage of their compensation tied to company stock performance, Roberts highlighted. That is to say, when things are about to fall apart on Wall Street, a way to reduce the damages faced by a company is to decrease the amount of this company's shares in the market. In that way, when the market goes down, the impact on the company's stock price is far more manageable. In 2018, Roberts noted that most corporations use the benefits of tax cuts to boost bottom-line earnings rather than increase wages. He wrote, "This is financial engineering gone mad." Share buybacks only return money to those individuals who sell their stock. This is an open market transaction, so if Apple buys back some of their outstanding stock, the only people who receive any capital are those who sold their shares, Roberts explained. Even the Financial Times has warned about this practice, saying corporate executives give several reasons for stock buybacks, but none of them has close to the explanatory power of this simple truth. Stock-based instruments make up the majority of their pay, and in the short term, buybacks drive up stock prices, it wrote. If it wasn't for stock buybacks, all of these insiders would not be able to sell off their stock at record high valuations without suffering major losses. For example, Elon Musk has sold more than $10 billion worth of stock in November to allegedly cover taxes on options exercised. That led Tesla stocks to crash by 18%. Now, approximately $5 billion of that sum has actually gone toward taxes owed from options exercising, but the rest of the money, almost $4.4 billion after taxes, has gone directly into the pockets of Elon Musk. Today, at least 40% of the current bull market is entirely due to buybacks. That's a Ponzi-like scheme that allows corporate insiders to prepare a financial cushion before the market takes a turn for the worse. The financial elites are panic hoarding cash because they know that exceedingly difficult times are coming. This insider selling wave accelerated in recent weeks because, as Goldman warned, the buyback open window for 2021 ended on December the 10th. If we take a deeper look in the current market, we can see that damages are not superficial, as some are choosing to believe. Last week, a sell-off trend came fast and furious, with the S&P 500 4% lower than its all-time high set in early November. When we look underneath the surface, the meltdown is worse than it seems, according to Art Hogan, Chief Market Strategist at National Securities. Hogan says when you pull back the trunk lid a bit and look at what's been going on underneath the surface, you see that there's been a massive sell-off in everything related to momentum and growth. All the investors' darlings, a lot of the travel and leisure names, Hogan pointed out in an interview with CNBC. Last Monday, almost half of the S&P 500 was in correction territory or worse, having dropped at least 10% from 52-week highs. Amongst the hardest hit stocks, Penn National Gaming, Biogen, and Gap have plunged more than 50% from their highs. So, we've seen a real correction in those, Hogan said. Certainly the number of names that are at 52-week highs versus 52-week lows sits at a level where we can say we've done a lot of the damage in the near term, and it's likely pointing to the fact that if not today, certainly this week, we will likely see a point at which most of this negativity that's worked its way into the month of December has worked its way into prices of stocks, the strategist continued. We've had an outsized reaction in markets to the two latest headwinds at a time where valuations were looking pretty stretched in November, so it's not just about what's going on this week and last. I think it's about what's been going on since we made a peak in November, he highlighted. The truth is that, since the beginning of November, insiders could see that the bull market had its days counted. And from that point on, they started to take action to protect themselves. This sell-off madness is proof that a much more devastating stock market crash is fast approaching. Investors betting on higher stock prices will be bitterly disappointed. Even the dot-com crash wasn't recognized as such until it was too late. It's time to wake up now. Otherwise, you might be left scrambling when all of these stock market crash predictions become a reality.